Good morning and welcome to today's webcast, GASB Revisions and Impacts for Organizations. Before we begin, I'm going to play a brief housekeeping video.
Welcome, and thanks for joining us. We're pleased to present another in our ongoing series of continuing professional education webcasts to help companies and individuals conquer challenges as they plan for what's next. Our presentation will start in a few moments. Before we begin, here are a few things to keep in mind. You can customize how you both view our presentation and interact with the presenter. For better viewing, close all other applications and turn up your speaker volume. You can also adjust window size and placement or enter full screen mode using the controls at the top of the window or dragging the bottom right-hand corner to resize. At the bottom of your screen, you'll see a series of icons, each relating to a different aspect of our session. You can download the group attendance sheet and a PDF copy of today's slides from the slide deck and handouts widget to the right of the slide view. You can ask our presenter questions during the webcast by typing a question in the Q&A window below the slide view and clicking submit. We'll do our best to answer all questions during the presentation or follow up via email. If you experience technical difficulty during today's presentation, refresh your browser by hitting the F5 key. Today's session will offer you 1 CPE credit. To receive credit, you must meet the requirements as specified by the National Association of State Boards of Accountancy. You must attend at least 50 minutes of the session and respond to at least 75% of the polling questions, which we'll ask throughout today's presentation. To respond to a poll, click the button next to your answer. We'll track your progress and alert you when you've earned CPE credit. You can then click the certificate icon in the CPE Progress widget to open a PDF file that you can save to your computer. Don't worry if you can't download your PDF certificate today. We'll email a copy to you in 2 weeks. If you're attending this webcast in a group, you must complete our attendance sheet to receive CPE credit. The attendance sheet is available in the slide deck and handouts widget. Please have all group members sign it and send only 1 sheet per group. Also note that CPE credit can be awarded only to participants registered as themselves and isn't available to participants who view the on-demand version. As a reminder, the presentation you're about to see isn't legal, investment, or accounting advice. We encourage you to seek the counsel of a professional service provider to apply this content to your specific circumstances.
I'm pleased to introduce today's presenters from our Moss Adams Government Services practice. Ashley Osten, Partner, Keith Simovic, Senior Manager, and Kevin Mullerleile, Senior Manager. With that, I'll turn it over to Keith to get us started.
Perfect. Well, thanks, Kendall, and welcome, everyone. We're excited to have all of you here today, at least virtually, for our GASB update presentation. Again, my name is Keith Simovic. I'm a Senior Manager with Moss Adams. I focus on clients mainly in both the power and utility space and government services space. So I get to spend a lot of time working with all of our client base on interpreting and applying new GASB standards. And I'd say, it's definitely a busy space to focus in, as many of you probably have felt as well. GASB doesn't seem to be slowing down at all when it comes to issuing new and from time to time complex standards that can and do really have a significant impact on all of our accounting policies or procedures and really ultimately our financial reporting process. We want to make that process of kind of soaking in the new standards a little easier if we can today and really help you to understand some of the more significant upcoming standards that will need to be implemented in the not too distant future. And to help a little in this process and just to make sure you get to hear a little more than just my voice for the next hour, I've got 2 other presenters with me here today. Kendall mentioned both of them, Ashley Osten and Kevin Mullerleile. They're both members of our firm's government services practice as well. And we'll be taking the lead on breaking down GASB's 87, 91, and 95 after I kick things off with GASB 84. And even with just limiting this presentation to a few standards, we've still got lots to cover, so we'll go ahead and dive right in. I mentioned our standards that we're covering today in our agenda, so I'll go ahead and move forward. For our learning objectives, these consist primarily of really just gaining a better understanding of some of the newer standards that were listed in that agenda and coming out of this better equipped to assess the impact of each of those and to help with developing or really refining your organization's plan for implementation. So I guess if we can accomplish those items today, then I think we've hit our goals for this session. So starting off with GASB 84, I have to say that this standard is one that is near and dear to my heart, as we've helped a lot of clients over the past, several months and the past year, kind of navigate through, really the challenging aspects of this one. And prior to the issuance of GASB 95, which I mentioned Kevin would be talking about later, this one was initially slated to be effective for periods beginning after December 15th, 2018. So for many of our clients with 12/31 year ends, this was one that was needing to be implemented for the 12/31/2019 financial statements, up until the point that GASB 95 was issued. And that really delayed the effective date of this and many other standards. So as a result, I would guess, and we should have had a polling question on this, I guess, but I would guess if we polled the audience that some of you have already implemented this one. Some have implemented but may need to make changes next year, excuse me, due to the issuance of GASB 97. Some may have started implementing but then pushed out the implementation date another year because of GASB 95. And some of you may not anticipate that the standard will really have any impact and haven't spent much time on the standard yet. So given all of the various moving pieces with GASB 95 and 97, as well as kind of the complexities of the standard to begin with, this is a great time to revisit GASB 84 and the impacts that it could have on your financial statements in the coming year. So before we dive in too deep on this one, it's probably a good idea to step back for a minute to understand the why behind the standard. Prior to GASB 84, fiduciary activities and fiduciary funds were always a part of GAAP, but the problem was that the concept of a fiduciary activity was not clear in the guidance. So there were inconsistencies in what was considered a fiduciary activity by one organization or an industry, and that may not have been the same interpretation as another organization or industry. So it was this wide diversity in practice that led to the need for clarified guidance under GASB 84 to really lay out, what types of relationships would trigger the need for including fiduciary funds in a set of financial statements. And I'd say the goal in all of this is really to have consistent application of this concept of fiduciary activities in financial reporting across all organizations and industries that are subject to GASB standards. So under the standard, there are 4 categories of fiduciary funds that are listed out. Pension employee benefit trust funds, and keep in mind this could include defined contribution plans, not just defined benefit pension plans. Investment trust funds, private purpose trust funds, which are, fiduciary activities other than pension and investment trust funds and are held in a legally separate trust, kind of meeting the criteria of GASB 84. And then there's custodial funds, which really kind of replaces the concept or current concept of agency funds. And these are similar to a private purpose trust fund, but just aren't necessarily held in a trust. Fiduciary activities are required to be grouped in each of these categories and reported separately in the statement of fiduciary net position and the statement of changes in fiduciary net position within an organization's financial statements. So if you haven't had to report fiduciary funds in the past, but think you might need to under GASB 84, just keep in mind that those 2 statements will need to be added to your financial statements in the year of adoption and going forward. So work with your auditor, or if you have questions or need examples of what those statements specifically might look like, and there's lots of good examples out there within the GASB guidance as well. All right, on this slide, we just have a few examples to get you thinking about what might fall under the category of fiduciary activity, or at least what types of activities might need to at least be evaluated for whether they meet the requirements under GASB 84 to be reported as a fiduciary fund. In all of these examples, and as you start assessing the impact of this standard, the main theme to think about is, does my organization hold funds for the benefit of other individuals or organizations, whether held in a legally separate trust or not, and what fiduciary relationship or responsibility does my organization have for those funds? I think that's really the main theme. And that's really the first key question to ask when trying to put together a list of potential fiduciary activities. This list of examples isn't comprehensive by any means, so just keep those main themes in mind when evaluating potential fiduciary activities. I know I mentioned the initial effective date previously, but also hinted at the fact that GASB 95 allows for deferral of the effective date. And in this case, the deferral period is up to 1 year from the original effective date. So that means that GASB 84 implementation can be implemented for periods beginning after December 15th, 2019. You've got a little extra time to work through this one if you haven't already. You may want to keep in mind, the extra time it could take to implement if new fiduciary funds are identified in this process, given that retrospective application is required. So that means, 2 years of data will be required in the annual financial statements, not just 1. Not to mention that both years would be subject to the annual audit process as well for the first time if there's new fiduciary funds. I know we've had a few clients who implemented this one prior to the issuance of GASB 95 and maybe didn't anticipate, the time and effort it would take to gather the info for both years. So, just something to think about with this one as you move forward with implementation. So some things to think about with implementation, we wanted to provide you with a few guideposts to help you along with the implementation process. I think the first and probably the hardest would be to identify the population of potential fiduciary activities. I think this is probably an exercise that will require discussion and involvement from management and individuals outside of just finance, really just to help identify the different, whether it's employee benefit plans or trust funds or other programs in place where the organization could be considered to have fiduciary responsibility over those assets. But once that population is set, the next step is understand some of the key facts about each potential fiduciary fund to help you navigate the GASB 84 criteria. I think some great resources to help you navigate this evaluation are the actual flow charts that you'll see included within, I think it's Appendix C of GASB 84. And we've included these on the next few slides, but I would suggest printing these out at some point and referring back to them frequently when implementing the standards or when assessing any new potential fiduciary activities going forward. And we'd also recommend kind of reading through the implementation guide. It's Implementation Guide 2019-2, because there's many pretty good examples in there to help you understand kind of how to apply the standard. So we've included on the next 3 slides all these charts in here that I mentioned were in Appendix C, just to get you familiar with what they look like. But I know they can look a little busy and complex at first, so I'll go past these quickly to navigate to the slide where we kind of break down the main pieces of the evaluation. But one thing I will say that I think isn't quite clear or quite as clear in these flow charts as they could be would be the very first decision point on this one that I've got up here, chart number 1. You'll see in the upper left corner of this flow chart, it asks about whether the assets are held by a legally separate entity or trust. That would be considered a component unit. I think the question here is definitely fine and on the right track, but I think it would be more helpful to start with a flow chart to help you make the determination of whether there's a component unit relationship or not. And this doesn't really walk you through that, it just asks the question. So I think we should start there with our discussion kind of on the next few slides. So I'll move through these different charts just again so that you see these and are familiar with what they look like, but again, all within the GASB 84 guidance in Appendix C. So to help break this down, first, so component unit is defined by GASB as a legally separate organization where the primary government and its governance group, so think, board of directors or city council or something like that, where that governance group is financially accountable to that legally separate organization. So both of those are bold here as they are key concepts and criteria within the component unit evaluation. But what do they really mean and how do we apply them in our assessment? Well, some questions you might want to ask would be, does the potential component unit, when you think about legally separate, does the potential component unit have its own name or can it legally sue or be sued under its own name without any impact to the primary government? So for example, think about something like a defined benefit pension plan that has assets held in trust for the purpose of accumulating and paying pension benefits. If the plan and the trust were to be sued, could the assets of the sponsoring government also be at risk in that case? And if not, that could be one indicator that the plan and trust is legally separate from the primary or sponsoring government in this case. For the financial accountability piece, there are a couple items to understand, including whether the governing body of the primary government appoints a voting majority of the governance group of the potential component unit. So going back to the last example, if that pension plan had a board of trustees, would the board of directors or council members or whatever of the primary government be responsible for appointing a voting majority of that board of trustees of the plan? And also, what type of financial relationship does the primary government have with the potential component unit? So again, going back to that example, if the government is responsible for making contributions to the trust, then there is a financial burden aspect that helps to build a case for the pension trust being considered a fiduciary component unit of that primary government. And when that is the conclusion, then the flowcharts that we looked at earlier, are pretty quick and easy to complete, as those component units would need to be included as fiduciary funds. As we'll see with the next few slides, the flowcharts are a little more helpful, I'd say, when you come to the conclusion that you don't have a fiduciary component unit, but you still need to go through a few more considerations to see if the activity would meet the criteria of a fiduciary fund. So if you don't have a component unit, you're not in the clear quite yet. And the next step is to determine whether the primary government controls the assets. So paragraph 12 of GASB 84 defines control as 1, either holding the assets, or 2, having the ability to direct the use, exchange, or employment of the assets. So let's say, for an example, that the primary government holds the assets in one of its bank accounts. You would then move on to the next evaluation step, which is to determine the source of the revenues for the activity in question. Fiduciary funds cannot have revenues that are derived from the primary government's own source revenues. So you think about that, well, what does that really mean? I'd say, a good example of this is in the implementation guide, and it's a scenario where a city charges a business license fee of $1,500 to various organizations that apply, but through a revenue sharing agreement with the state, the city remits $150 of that fee to the state each period. The portion that the city holds that will be remitted to the state would not be considered a fiduciary fund, given that the assets are the result of the city's own source revenues in an exchange transaction with a customer. So charging that $1,500 to a customer is an exchange transaction and would be considered own source revenues. And there's a lot of other good examples in the implementation guide. I think it's starting with question 4.35 in that implementation guide 2019-2. So, if you're going down this path on the flowchart and you get to this point, you want to see some more examples of what does it mean by own source revenues, I would recommend taking a look at those examples for a little more insight on this. So the last step is determining if the activity meets any one of the criteria listed here. Are the assets held in a trust? Are they held for the benefit of individuals and not the primary government? If not, are they held for the benefit of other organizations that aren't already a part of the reporting entity, such as, maybe a already identified component unit or something like that. So if any one of those is met, and you've already met the first two criteria, then the activity would be considered to be a fiduciary fund. So I'll stop there. That's a lot of info to soak in, I know, but I think it helps if we can start to look at how the standard is applied to specific examples. And this is where kind of the flowcharts would come in to kind of use some of those to help you navigate. So let's move on to the next phase, where we'll go through a few scenarios and some multiple choice questions and hear what you guys have to say. So for the first example, let's say that you've got a pension plan administered through a trust, but does not have a separate governing body. Instead, the sponsoring government essentially functions as the governing body of that plan and is responsible for performing all of those duties. And in addition, the sponsoring government is obligated to make contributions to fund the plan. So think about those, that fact pattern for a minute. And we'll come to our question of, is the pension plan a fiduciary component unit of the sponsoring government? We'll pause, we'll see what you guys think, and I'll pass this on to Kendall for our polling question.
Great, thanks, Keith. For our first polling question, we have, is the pension plan in the previous example a fiduciary component unit of the sponsoring government? The options are A, yes, it qualifies as a fiduciary component unit of the sponsoring government. B, no, it doesn't qualify as a component unit, but it does qualify as a fiduciary fund of the sponsoring government. C, no, it doesn't qualify as a component unit or a fiduciary fund of the sponsoring government. I'll give you a few moments here to respond. To participate, please click the button next to the answer you choose and hit submit. All right, we'll go ahead and take a look at the results. Back to you, Keith.
Perfect. Thanks, Kendall. So it looks like the majority of you thought response B, that no, it doesn't qualify as a component unit, but it does qualify as a fiduciary fund of the sponsoring government. And the second most would be response A, yes, it qualifies as a fiduciary component unit of the sponsoring government. So moving forward to the answer here, and this is a tricky one, and you know, to some degree, you know, they would be reported similar in your financial statements, whether it was answer B or answer A. As they would be reported as a fiduciary fund, but this is kind of a nuance of how do we get to that conclusion that it's a fiduciary fund, and really it's that it's considered a fiduciary component unit. So response A was correct there. And the reason for that is, you know, if we go back to the criteria for a fiduciary component unit, you know, the assets have to be held by a legally separate entity, so a trust in this case. And the sponsoring government has to be financially accountable and have a financial burden to the potential component unit. So in this case, the sponsoring government functions as the governing body of the pension trust, and it also is obligated to make contributions to the plan. So with all those boxes checked, this one is a fiduciary component unit. We'll move on to the next example. And here we have a government that is the custodian for cash collected from fees charged by a local cemetery association for future maintenance of the cemetery. The cemetery association is a legally separate, not-for-profit entity and not considered a component unit of the government. The assets are held in trust for the benefit of others, and those assets are protected from the government's creditors. The cemetery association determines how the assets will be spent, and the government is not involved in this decision-making process. So think about that. Now let's go to the question of, is the cemetery trust a fiduciary fund of the custodian government? Now we don't have a polling question on this one quite yet, but we'll tweak the fact pattern here on this one a little bit in a minute and then put this out in a polling question to see what you guys think. But we'll just go through the answer on this one real quick first in this question 2A. So the answer on this one was that it is a fiduciary fund of the government, but it's not a fiduciary component unit, and specifically falls under the classification of a public purpose trust fund. So since the government is acting as the custodian and holds the assets, it is considered to kind of meet the control requirement in GASB 84. The assets are derived directly from the cemetery association, so it wouldn't be considered to be derived from the government's own source revenues. And then lastly, the assets are held in a trust. So all three boxes there are checked, and this one would be a fiduciary fund of the government. So I said I was going to tweak the fact pattern a little bit and then put it out for another polling question. So kind of to throw a twist on this one, you know, does our conclusion change at all if the activity is not administered through a trust? All right, back to Kendall for this polling question.
All right, for our second polling question, does the conclusion to the previous example change if the activity is not administered through a trust? The options are A, yes, if the assets are not held in a trust, then it does not qualify as a fiduciary fund of the sponsoring government. B, slightly, the activity is still considered a fiduciary fund of the sponsoring government, but it qualifies as a custodial fund rather than a public purpose trust fund. C, no, the activity is still considered a public purpose trust fund. As a reminder, if you would like to receive CPE credit for today's webcast, you'll need to respond to at least 3 of the 4 polling questions. Give you a few more seconds here. All right, let's close out and take a look at the results. Back to you, Keith.
All right, looks similar. Everyone liked response B for the most part, and then I think response A was the second most. So response B was, does our conclusion change? It says slightly, the activity is still considered a fiduciary fund of the sponsoring government, but it qualifies as a custodial fund rather than a public purpose trust fund. And I'd have to say, you guys are correct. That's awesome. And it's a tricky one since, the conclusion really overall didn't change in that this would be a fiduciary fund of the sponsoring government. It's just that the type of fiduciary fund changed. We mentioned 4 different types of fiduciary activities earlier in the presentation, and custodial funds are basically fiduciary funds that don't fall into the other buckets and are not held in a trust. So in the previous question, it was considered a private purpose trust fund, since in that scenario, the assets were held in trust. So it's a slight nuance here, but in both cases, it would be a fiduciary fund reported within the government's financials. So good job on that one. Couple more slides real quick before moving into GASB 87 with Ashley. But just earlier this month, GASB issued GASB 97, which modifies GASB 84 and certain questions and answers from the implementation guide, kind of by adding certain exceptions for evaluating defined contribution employee benefit plans. So think 401ks, 401as, 403bs, things like that. GASB had received a lot of feedback from industry kind of stating that the burden of including these plans as fiduciary funds and really subjecting them to audit as well outweighed the benefit to users of the financial statements. So the main provisions that will change under GASB 97 for defined contribution plans was that the absence of a governing board does not automatically mean that the sponsoring government is financially accountable. And in addition, the financial burden aspect that was also causing some defined contribution plans to be pulled in as fiduciary funds if sponsoring governments were making any employer contributions to the plans. This criterion kind of will now be applicable only to defined benefit plans. So definitely gives you a little bit of an out there for some defined contribution plans. The intent in all of this is that fewer defined contribution plans will be required to be reported as fiduciary funds. And if you've already implemented GASB 84 and ended up pulling in some defined contribution plans as fiduciary funds, I'd say and recommend spending some time reading through GASB 97 definitely, and then reassessing whether those plans would still need to be included as fiduciary funds in the next reporting cycle or not. There's still a chance that some defined contribution plans would still need to be included if the other fiduciary criteria, other than kind of that component unit criteria, are met. So just keep that in mind, that this new standard doesn't automatically scope out all defined contribution plans, but it does limit the applicability of certain criteria, making it a little more difficult for those types of plans to be considered fiduciary funds. Okay, well, thank you everyone for your time today thus far. And at this point, I'll turn it over to Ashley, and she'll help you navigate through the new leasing standard. So go ahead and take it away, Ashley.
Okay, great. Thanks so much, Keith. Great job. I'm going to spend my time talking with you a little bit about GASB 87. So this standard was issued back in June of 2017, and really the spirit and intent of the standard was to really get to the better meet the needs of financial statement users by improving accounting, financial reporting around leases by governmental entities. If any of you follow the FASB, then FASB issued a similar standard on leases back in 2016. So this slide and the next three are primarily meant to provide kind of a quick refresher on the updates to lease accounting. I'll try to breeze through these so that we can focus the majority of our time on the implementation issues that we're seeing as a result of reading through the guidance, and also any of those clients that we have that have already implemented GASB 87 and talk through those significant items. So the new lease standard provides for a new lease definition. A lease is now defined as a contract that conveys the control of the right to use another entity's non-financial asset for a period of time in an exchange or an exchange-like transaction. Examples of non-financial assets include things like buildings, land, vehicles, equipment, things like that. This next slide is really looking at the specific accounting for both lessees and lessors. So as you can see, a lessee recognizes a lease liability and a lease asset at the beginning of the lease term, unless the lease is a short-term lease or it transfers ownership of the underlying asset. The lease liability is measured at the present value of future payments expected to be made during the lease term, and the lease asset is measured at the amount of the initial measurement of the lease liability plus any payments made or initial direct costs to place the asset into use. A lessor will recognize a lease receivable and a deferred inflow of resources at the beginning of the lease term. A lessor shouldn't de-recognize the asset underlying the lease, and similar to the lease liability a lessee recognizes, a lease receivable should be measured at the present value of lease payments expected to be received again during the lease term. And then the deferred inflow of resources should be measured at the value of the lease receivable, again, plus any payments that were received upfront that relate to future periods. So this is really getting at the income statement side. So a lessee should reduce the lease liability as payments are made and recognize an outflow of resources like an expense for interest on the liability. And then the lessee should also amortize the lease asset in a rational manner over the shorter the lease term or the useful life of the underlying asset. For a lessor, you still depreciate the leased asset unless it's an indefinite-lived asset, and then you reduce the receivable by lease payments that are made over the course of the lease term. And then on the other side, you recognize revenue over the lease term, again, in a systematic and rational manner. So just a quick note on those leases that GASB 87 doesn't apply to. I won't read every single one of these items on this slide, but just know that there are some exceptions to what GASB 87 does apply to. So what will you need for implementation? If we were, of course, in a room together, I'd be able to ask by show of hands if any of you are actively starting to inventory your organization's leases, trying to gather all those together. If not, that's a great place to start. Specifically, as you look at the commitments disclosure and your organization's financial statement footnotes, there you'll find hopefully all of the material operating leases that are most likely to meet the definition of a lease and fall under this new guidance. From there, it's important to actually dive into the lease agreements, read them, identify the key provisions that are listed on this slide, things like the lease term, extension or termination provisions, the interest rate, things like that. One of the most important items an organization will need to do as it looks to implement this standard, though, is to really effectively communicate across departments to ensure that all leases are identified. And as all of you know, governmental entities have lots of different departments that engage in a lot of different types of activities, so it'll be really important to bridge that gap and effectively communicate to be sure that all those leases are identified. So now we're going to talk through about 5 or 6 implementation challenges just based on reading through the guidance and trying to identify where things might trip up our clients. So understanding the lease term is going to be one of really the key issues to consider in the implementation of GASB 87, and it requires organizations to look at their leases and consider if there are groupings of similar types of leases or lease situations, and potentially develop policies around how that lease term is determined. So ideally, organizations will want to avoid inconsistencies in that decision-making process across those similar agreements. But it's also hard to just have a blanket policy because there's some ability to use hindsight to understand the entity's previous experience. So as you look at this slide, the lease term starts with and only includes the non-cancelable period. This is, of course, unless you're expecting to exercise the option to extend the lease, in which case that's added to the lease term, or terminate the lease early, in which case that time period is removed. At the commencement of the lease, the lessee and lessor will need to look at and consider items including whether there's a significant economic incentive or disincentive to either extend or terminate the lease early, the history the organization has of exercising options to extend or terminate their leases, and the extent to which the asset underlying the lease is quote-unquote essential to your organization. The government will then need to reassess the lease term if the option to extend was exercised, but it really wasn't expected to be exercised. And contrary to that, if the option to extend wasn't exercised, but initially expected to do so, the lease term will need to be reassessed. So lots of differences there in identifying the lease term and potentially some challenges. Another challenge organizations potentially will face will be fully understanding lease incentives. If they're infrequent, then there will need to be some sort of mechanism to identify those lease incentives, which will potentially require some additional consideration, maybe some policies or procedures that need to be implemented, as well as, again, communication across departments. And just so we're all on a level playing field, I'll remind you of the definition of a lease incentive. Those are payments that are made to or on behalf of the lessee for which the lessee has a right to offset its obligation to the lessor, or other concessions that are granted to the lessee. It's a mouthful. Lease incentives that are provided at or before the inception of the lease will, as noted on this slide, result in a direct reduction of the lessee's lease asset. Those amounts will be included in that initial measurement that you do of the amount of the lease asset. Incentives that are provided after the inception of the lease should be accounted for as reductions of lease payments in the period provided and reduces the present value of the lease liability. So if a lessee or a lessor enters into a contract that contains both a lease component, things like the right to use a building, and a non-lease component such as maintenance services for that same building, the organization should account for the lease and the non-lease components as separate contracts, following the steps, again on this slide and as well as in the guidance. The first step is to separate that contract into lease and non-lease components. To allocate the contract prices to those various components that have been identified, lessees and lessors first should use any prices for individual components that are included specifically in the contract, so long as that price allocation doesn't appear to be unreasonable based on the terms of the contract and also your professional judgment. Of course, all of this needs to be done by maximizing observable information and, again, using the best estimate based on your professional judgment. Another tricky area that could provide organizations with implementation challenges is surrounding lease modifications. So lease modifications result from amendments to a lease contract, not from exercising options in the original contract. So you would account for a separate lease if the lease modification gives you, say, access to another asset that wasn't included in the original lease contract. Unless a modification is reported as a separate lease, a lessee should account for a lease modification by remeasuring the lease liability, and a lessor by remeasuring the lease receivable. Then you adjust that lease liability as noted on this slide and the lease asset by the difference between the remeasured liability and the liability balance before that modification was made. So another implementation challenge is surrounding sublease accounting. So when there is a sublease that occurs, the original lessor should continue to apply the general lessor guidance. The government that's the original lessee and becomes the lessor in the sublease should account for the original lease and the sublease as two totally separate transactions. One is a lessee, one is a lessor. Those two separate transactions do not offset against one another. The original lessee should include the sublease in its disclosure of the general description of the lease arrangements it has, and its lessor transactions related to subleases should be disclosed separately from its lessee transactions, which were related to the original lease. Finally, I think this is the last implementation challenge that we're going to talk about this morning, but what about intra-entity leases? So when the lessee or lessor is included as a blended component unit of the primary government, the reporting requirements of GASB 87 don't apply. Instead, when the lessor is a blended component unit, the debt and the assets of the lessor should be reported as if they were the primary government's debt and assets. With respect to leases with or between blended component units, eliminations should be taken place before the financial statements of the blended component units are aggregated with those of the government. Lease arrangements between the primary government and a discretely presented component unit should be treated in the same manner as any other lease under the guidance of GASB 87. However, those related receivables and payables should not be combined with other amounts that are due to, due from discretely presented component units. They should be separately stated on separate lines on the financial statements. So now I'll hand it over to Kendall to go through our third polling question.
Thank you, Ashley. For our third polling question, we have, as you look forward towards implementation, what do you believe will be the most important item for your organization to review? The options are A, internal control policies and procedures to identify leases and lease modifications. B, the impacts on debt limitations, bond covenants, and grant agreements. B, the mechanics of how leases will be tracked by my organization. D, all of the above. For those of you that would like a copy of today's slide deck, you can download them from the folder that says Slide Deck and Handouts to the right of the slide view. We will also be sending the slides via email after the webcast. Let's go ahead and close out and take a look at the results.
Okay, yeah, this was a little bit of a, okay, thank you, Kendall. This was a little bit of a softball of a question, and we didn't talk about it in any of the implementation challenges. It's really just a foreshadow into what is to come in the next few slides before I transition to Kevin. But yes, all of the above, and we'll go through some best practices now. So when should you start on implementation? Of course, the sooner the better. The GASB did provide a gift earlier this year via GASB 95, which Kevin will touch on at the end of this presentation, but the effective date for GASB 87 has now been pushed out until periods beginning after June 15th, 2021. So there is a little bit more runway, but as we all know, that initial time investment in a standard that is as significant as this one can be significant, time intensive, and due to the complexities and some of the implementation challenges that we just talked about, it's clear that if you haven't started your implementation efforts, you should not delay. Start today. So as you consider internal controls, another best practice, please consider if there are additional people that you need to bring in, additional departments, additional controls that potentially need to be added with respect to your government's IT systems or any other tools that the government chooses to implement in response to the implementation of GASB 87. The most important item is really to ensure that there are clear roles, segregation of duties for things like the preparation and approval surrounding all of the various implementation challenges we discussed, lease determinations, calculations, journal entries, and then also really segregating that user access if you are implementing a different system to assist the government with implementing GASB 87, making sure that user access is appropriate. And there are controls around change management and security and access. And then finally, one final best practice is to consider that debt agreements often contain those restrictive financial covenants, and those can be impacted by a significant accounting change, especially in light of the fact that this standard will bring on substantial liabilities if the government has significant operating leases. So just a reminder here to consider identifying all those financial covenants that the governmental entity must comply with, and then calculate those ratios or covenants based on the implementation of GASB 87. This will allow you to have conversations with those that you need to have conversations with if you're not in compliance, and gives you a little bit of greater understanding about how the implementation of GASB 87 will impact your organization. You may also consider other changes to internal policies as a result of those calculations. And one final just quick plug before I turn it over to Kevin to go through GASB 91 is as well as a few additional standards. If you've enjoyed this piece on GASB 87, I know it's been pretty short, pretty high level, and would like to take a deeper dive, please join us Thursday, July 9th. It's an hour-and-a-half long webinar to go through the adoption and best practices for governmental entities as it relates to GASB 87. We've included a link here to the registration page, or you can feel free to search for it at mossadams.com. So I will turn it over to Kevin to take us through to the end.
Thanks, Ashley. Great job on leases. So the topic now is GASB Statement 91 on conduit debt obligations. Previously, conduit debt guidance was all the way back in GASB Interpretation 2. That was issued 1995, so we're talking 25 years ago. That interpretation said the term conduit debt was synonymous with no commitment at all. So while there may not be a true commitment for the issuing government, there are underlying lease and mortgage loan type agreements in these documents which can kick in some obligations of the issuer. So financial statement users are interested in these agreements and would like to see these types of commitments disclosed in the financial statement footnotes. In practice, with the pre-existing gap that's out there, financial statement preparers haven't consistently been following the GASB Interpretation 2 guidance. With a lot of new standards, it's often GASB saying, let's bring everyone together on the same playing field. Some have been disclosing commitments, others haven't. Some have been actually reporting conduit debt liabilities on their financial statements when GASB Interpretation 2 really doesn't require that they do so. Now, I practice primarily in Oregon. I do get outside of the state, serve clients, but just looking around some of the largest cities and counties that report conduit debt, the largest city in Portland discloses about $17.5 million. That's for economic development. A couple of the largest counties combined for almost $500 million of conduit debt for healthcare facilities, and another large county has $35 million in affordable housing facilities. So those are the type of projects that we're seeing with conduit debt. If you're wondering if your organization has conduit debt and you've never thought about it, or maybe you've just moved to a new government and are just kind of getting used to sitting in the seat, one thing you could do is go online to EMA, the municipal filing website, and you could do a search of your government. Now, if you have conduit debt, it's not going to be in your government's name. But let's say you're in a county in Washington, you put in your county's name, XYZ County, Washington, and if you see something else next to your name, like health facilities or public housing facilities, that could be a sign of conduit debt that your government has issued. But what is conduit debt? What's the definition? Well, these are like revenue bonds, certificates of participation, or other similar debt instruments issued by a state or local government for capital financing. So we're talking about capital projects. We're not talking about refundings or pension bonds. And these are for specific third party that's not part of the issuer's reporting entity. So although the name of the debt is in the issuer's name, whether it be a state, a county, city, on the surface, they have no obligation for the debt beyond the resources provided to the third party. Now, often the third party's capital project is what secures the bonds, is going to be their collateral. So that capital project is what is securing the debt. You might ask, why do governments issue conduit debt? But it can be seen as good business for the community as a whole. By using a state local government issuer for the conduit debt, the third party can borrow at a much lower borrowing cost. Third party was to finance its capital projects through other means. It really could be more expensive to them. So in Statement 91, paragraph 6 is where you want to look to see the 5 criteria that must be present in order to have conduit debt. I think 4 of these are pretty easy to get your arms around. On criteria number 1, just know that there's always going to be one issuer. You can have multiple third-party obligors or multiple trustees involved. With number 2, the issuer and the obligor cannot be part of the same reporting entity. Just kind of poking around at different footnote disclosures I've seen out there. I did see a disclosure that made it sound like the third-party obligor is a component unit of the issuing government. Now, there was some discussion in there about the component unit possibly being immaterial to the primary government. But if you do have that sort of relationship going on with the implementation of Statement 91, I think it's a good time to revisit those sorts of component unit relationships when you do have conduit debt. Number 3, debt isn't a parity bond or cross-collateralized with other debt of an issuer. If you look up the definitions of the terms parity bonds and cross-collateralized debt, they're very confusing. It's almost like the terminology is in the definition. So it's really circular, but just know if it's a parity bond or cross-collateralized, you don't have conduit debt, you just have plain old debt. Number 4 is fairly straightforward. These are proceeds that are for the third party to finance its capital project. And with number 5, if the issuer was responsible for debt service payments, you wouldn't have conduit debt to report. It's the third party obligor's responsibility to make the debt service payments. So all these 5 criteria need to be present to have conduit debt. Now I'm going to get into some of the commitments with these debt obligations. If you have conduit debt, there are going to be limited commitments. Things like maintaining the tax-exempt status. The big takeaway here is that limited commitments do not obligate the issuer to make any debt service payments. What is going to possibly obligate the issuer to make debt service payments is these additional commitments. On the first bullet point, committing to support the debt of an obligor is if they're unable to make their debt service payments. I think that's fairly straightforward. You've made that commitment. They're not able to make the payments, then you need to step in and do so. Number 2, on moral obligations, the GASB didn't really define that in the statement, but if you look in their discussions on how they came up to the statement, they talked about the situation where a public official kind of makes an offhanded comment about stepping in to make a debt service payment. That's not really a moral obligation. There has to be some more formal action that takes place in order to have a moral obligation. Point number 3 on financial guarantee. You may recall a few years ago implementing Statement 70. When a government guarantees the debt of another entity in a non-exchange transaction, or if it's a exchange-like or exchange transaction, the more voluminous Statement 62 is what you look to there. What I want to bring up here is if it is conduit debt, you can forget about Statement 62 and 70. Statement 91 trumps those standards when we're dealing with financial guarantees related to conduit debt. Finally, the 4th bullet point, should the issuer pledge its own revenue or assets as collateral, that's an additional commitment for the issuer to disclose. The 3rd type of commitment is a voluntary commitment, and this is when the issuer just steps in and says, you know what, the obligor is unable to make its debt service payment. We're going to go ahead and commit to doing that. So that brings us to a polling question. Kendall?
Thank you, Kevin. For our 4th and final polling question, we have, which of these situations best describes your organization's situation as a conduit debt issuer? The options are A, we cannot issue conduit debt. B, we can issue conduit debt, but we haven't done so yet. C, we issue conduit debt and it's unlikely we'll be obligated to report a liability. Our reporting should be limited to footnote disclosure only. Or D, we issue conduit debt and it's likely to have a related liability to report. Once you have completed all CPE requirements, you'll be able to download a PDF of your CPE certificate from the CPE progress window to the right of the slide view. All right, let's go ahead and close out and take a look at the results. Back to you, Kevin.
Yeah, that looks about right. Most of you probably aren't in the position to issue conduit debt. It is interesting to see that almost 14% will have debt to report on the balance sheet. So in terms of recognition, if the issuer has just straight up conduit debt, there's no possible liability to recognize. Also, if only limited commitments have been made, there's no evaluation that really needs to take place for recognition. Now, if you do have those additional commitments or you step in and make a voluntary commitment, then an assessment needs to occur to determine if it's more likely than not the issuer will not be able to make its debt service payments, and you as the issuer will step in. GASB defines more likely than not as more than 50% in terms of likelihood. So in terms of evaluating the likelihood of support, an evaluation should be done at least annually if you have additional commitments. There are qualitative factors to consider. Those are going to be on the next two slides here. Realize that this isn't an exhaustive list. What comes to mind to me is a risk assessment the auditors do, or I see several of my government clients do, for when they make pass-through payments on a grant to a not-for-profit or another government. They're responsible for subrecipient monitoring, and several of my clients have really good checklists where they're walking through risk factors that are qualitative. Something like that would be helpful when you need to evaluate those additional commitments you have. So for recording the liability on the economic resources, this is if you're a BTA, or in the case of a general government, which is probably a little more likely, you're going to look at your governmental activities and see if a liability should be recognized on statement of net position or expense on statement of activities. Remember, we're talking about more than likely than not, so that's greater than 50%. The issuer will recognize their obligation to support those debt service payments they're stepping in to make. The liability is measured by discounting the present value of their best estimate of the future payments to support the debt. If there's no best estimate, then use the minimum range of estimates. In terms of governmental funds, governmental fund has the same threshold. Unlike the economic resources measurement, which estimates the measurement of the liability, the governmental fund's liability is reported when a payment to support conduit debt obligation is due and payable. So the amounts are going to be known. Really not going to need to estimate at that point. Associated arrangements, just quickly going to touch on that. The key thing to know here is that they're lease-like transactions, but they are scoped out of Statement 87, so they're not actually leases. What makes an associated arrangement differ is the issuer retains title to the capital asset from the inception of the arrangement. The only other point I want to make here is if you actually have a service concession arrangement, then turn to Statement 60 for the reporting guidance. In terms of note disclosures, here are the types of things to disclose. Under Statement 91, these are disclosures for everyone that has conduit debt issuances. Now, if you have additional commitments to disclose, these are the types of things you're going to report. There's going to be a new roll forward on the beginning and ending balances of your conduit debt, and then the ins and outs that occurred during the year. And finally, on implementing Statement 91, this is also pushed back under Statement 95. So for fiscal year ends out that are June 30, you're looking at June 30, 2023. So still a few years to assess this standard. Restatement is necessary if you have a liability to report. I would have you look at the standard and make sure that restatement is due to implementation and not conduit debt issuance that you just became aware of. If that was the case, then you may need to look at how you characterize that restatement. All right, GASB Statement 95, everyone's favorite standard. This is pushing back the implementation of all the new GASB standards out there. I'm not going to go through each of these, but just know that everything out there is a year. So probably you have nothing to implement this year. I know a few out there are early implementing some things. Statement 84, I've heard of governments that we're so close that they're going to continue and push on and early implement fiduciary activities. One final thing that's not on here, I just want to let you know the biggest standard that the GASB has out there is there a re-examination of the recognition of revenue and expense reporting? I just heard from either a representative of the GASB or the GFOA this past year that that standard is not going to be issued until 2025. And knowing that there's going to be a couple of years to implement, I mean, we're looking at 2027 would be issuance. So that's a huge standard that is in the early stages, but we still have a ways to go on that. Thank you for your time, and I'll turn it over to Kendall.
All right, thank you. Thank you, Ashley, Keith, and Kevin for a great presentation today. Unfortunately, we are out of time, but if you submitted a question that we did not get to, we will do our best to follow up with you after the webcast, or you may reach out to our presenters directly. As Ashley mentioned, we will be hosting another webcast on the adoption and best practices of GASB 87 coming up on July 9th. You can find the registration link within the slides here or on mossadams.com. If you attended today's presentation in a group and would like to receive CPE credit, you must complete the group attendance sheet found in the slide deck and handouts window to the right of the slide view. If you participated as an individual and met all certification requirements, your certificate is available to download now in the CPE progress window to the right of the slide view. I'll keep the webcast console open for a few more minutes to give you time to download your certificate. A copy of your certificate will be emailed within 3 weeks should you have any difficulty downloading it now. Here is a link to an online survey where you can provide feedback for today's presentation. Please take a moment to complete this survey as your feedback is very important to us. Thank you for joining us. We hope you'll join us again next time.